Hi, welcome to a video on the income statement, as well as comprehensive income and the statement of cash flows. There's three emphases in this module. We're going to consider the important issues pertaining to the development, content, presentation, and disclosure of net income and components of comprehensive income. You'll learn what all those terms mean, and these are crucial for the information provided to the user community. They are measures of the profitability and the cash generating ability of the company. We'll provide an overview in this module of the statement of cash flows. We'll learn to prepare the statement in a simple setting. In your next course, Financial Accounting Reporting 2, you will master its preparation. We'll also examine some common ratios that users and analysts use to assess the profitability of the company using information on the income statement and the statement of cash flows. So the learning objectives are: discuss the importance of income from continuing operations and describe the components of income from continuing operations. We'll also discuss the components of operating and non-operating income and their relationship to earnings quality. Define what constitutes discontinued operations, and we'll also describe the appropriate income statement presentation for these transactions that are known as discontinued operations. In an upcoming video, you'll see what that is. Explain the difference between net income and comprehensive income and how we report the components of the difference. We'll describe the purpose of the statement of cash flows, and we'll identify and describe the various classifications of cash flows that are presented in the statement of cash flows. Okay, here's an introduction. The financial statement's critical for understanding the company's ability to earn profits and generate cash in the future. There's two of them. There's the income statement and the statement of cash flows. So again, those are the two financial statements we provide in order that analysts can understand the profitability and the cash generating ability of the company. You'll learn how those two differ in this module. Let's talk about the income statement first. The income statement is a financial statement that presents information for a period of time. Remember, the balance sheet was a point in time financial statement where we said exactly what assets and what liabilities we had at that particular point in time of 11/59 at the end of the accounting period. On the income statement, we report the profits for a period of time. So in that second bullet point, we report a company's profit during a particular reporting period. Specifically, we report the revenues and the expenses and the gains and the losses for the organization during that period of time. We might be talking about a month, we might be talking about a quarter, we might be talking about a year. Indeed, we do all of those. In this class, we'll spend a lot of time talking about years as the period of time. One thing we saw in that bullet point is the terms revenues and expenses and gains and losses. Later in this video, you'll learn what distinguishes those two terms. Profit is revenues and gains minus expenses and losses. Some gains and losses are actually excluded from the income statement and shown as, quote, other comprehensive income, and included in the broader statement of comprehensive income. You'll see what types of transactions those are and why they're different. When we talk about the statement of cash flows, we'll learn that the statement of cash flows provides information about the cash receipts and cash payments of a company during a reporting period. The difference between cash receipts and cash payments represents the change in cash for the period. The sources and uses of cash at the company will be categorized by cash provided by or used in operating activities, cash provided by or used in investing activities, and cash provided by or used in financing activities. Those are the three general activities of a business. And again, we will see why the statement of cash flows profoundly differs from the income statement. So let's talk about the income statement and the comprehensive income as well, but we will focus primarily on the income statement for a while. Here's the structure of the income statement. There's 3 sections on the income statement. Income from continuing operations, the results of operations for operations that are going to be discontinued in the near future, and then earnings on a per share basis. Literally, with discontinued operations, these are parts of the company that the company has decided it is going to exit that particular business. And so we will break out the results of operations for that business and present them separately. The reason for this is that investors will be interested, of course, in what the results of operations were for that discontinued operations, but for making predictions about the future and the future profits of the company, they want to primarily use the income from the operations that are going to be continuing onward. Thus, we provide all of that information broken out. So as soon as a company has announced that a certain aspect of the business is going to be discontinued and operated and exited, we accountants go to town and break those results out. You will see an example of that in an upcoming video. So what's net income? Net income is the bottom line on the income statement. It's a crucial measure that is used very widely across the globe. Net income is the revenues minus the expenses and the gains minus the losses. Let's look at those terms. Revenues are inflows of resources resulting from providing our goods or services to customers. So, for example, Target provides goods to you. Netflix provides a service to you. Best Buy provides goods to you, and then the Geek Squad provides services to you. Those are revenue generating activities for those companies. What are expenses? Expenses are outflows of resources incurred in order to generate that revenue we just spoke about. It's the cost of providing goods and services. We attempt to establish a causal relationship between revenues and expenses. If causality can be determined, expenses are reported in the period of the revenue they helped to generate. A great example of this is cost of goods sold, where we have the units sold, and then right below that, we deduct what we paid, what the company paid for those goods, and then we get a net profit on those, a gross profit on those sales. Now, if causality cannot be established, we will do one of 3 things. We relate the expense to a particular period, such as marketing expense. We allocate the expense over several periods. A great example of that is plant and equipment depreciation. Or we expense the expenditure as it is incurred. That's expenditures related to, for example, electricity and R&D, which is research and development activities of the business. So let's talk about what gains and losses are as opposed to revenues and expenses. Gains and losses are increases or decreases in equity from transactions that are not classified as revenues or expenses. They also do not involve owners, such as capital contributions, where the owners contribute cash and get stock, or return of capital to owners via dividends. They do not reflect normal operating activities of the company. They do affect financial position, though. An example is the sale of investments or the sales of property, plant, and equipment. Here, these are not the very nature of the activities of the business. Like, for example, Target's primarily in the business of selling you the goods on the shelves. Those are the revenues. But a A gain would be if they sold one of their buildings. Well, that's not their main business, but it's still nice to make a gain, and we'll report that increase in wealth for you, the owner, as a gain on sale. Losses can arise due to, for example, inventory obsolescence, other assets that have fallen in value, and litigation claims, being sued. We'll see examples of all of these. So what is this income from continuing operations? Income from continuing operations is this is the revenues and expenses and the gains and losses arising from the company's operations that are likely to be continuing. Now, very often the case is that all of the operations of a business are continuing and there is no discontinued operations. In that case, we have no section speaking of discontinued operations. The first illustration we see in here will involve companies with no discontinued operations. That'll be in an upcoming video. There's three components to income from continuing operations. There's the operating income, the income generated by the revenue generating activities of the business, the sale of its goods and services, the non-operating income, you'll see examples of what goes in there, and then income tax expense. So let's look a little closer. Operating income. Operating income includes revenues, expenses, and gains and losses directly related to the primary revenue generating activities of the company. For a manufacturing company, for example, it's the revenue from selling the product minus the cost of goods sold and operating expenses to produce and sell the product they manufacture. The operating profit is gross profit, sales minus cost of goods sold minus the operating expenses. For a service company, it's the service revenue minus the operating expenses. Again, a service company being such as Netflix. Maybe also a smaller basis, the lawn care services or plumbers. Operating income. Non-operating income includes expenses and revenues and gains and losses not related to the primary activities of the business. Here's some classic examples of things that go into non-operating income. Interest revenue, interest expense, and gains and losses from selling investments, gains and losses from selling property, plant, and equipment. Now, there is a gray area here. For example, a bank would include interest revenue and operating income because that's the main business, the main service that a bank provides to its customers. But a Target would not include interest expense there because Target has made a financing decision and they could have easily financed all their assets with equity and not have that interest expense. That wouldn't be necessarily a good financing decision, but it shows why a company will put interest expense in non-operating income category. And then there's the income tax expense category. This is often called the provision for income taxes. It's another necessary expense of the business. It's the expenses paid on the profits, so we pay to the IRS a percentage of our profits, corporate profits, and we also pay to state taxing agencies and local taxing agencies a percentage of our profits, the company's profits. This is reported in a separate line beneath income from continuing operations before taxes. That's yet another subtotal. We'll see an example of this very shortly. Okay, income from discontinued operations. Just to introduce it. Again, we'll have a video on this shortly, upcoming. Income from discontinued operations includes the revenues, expenses, and the gains and losses arising from operations that will not continue into the long-term future, into the future. They've already announced they're being discontinued. Now, income statement formats. There are two classic formats you will see in the real world. No standard prescribes how to display the income statement. The two general approaches that are common are the single-step format and the multi-step format. We'll see examples of both. We'll produce them together in an upcoming case. In the single-step income statement format, we will list all the revenues and gains included in continuing operations first. We will then list all the expenses and losses. That will get us to income before income taxes, and then the income tax expense is still listed separately because it is a function of the net income. Let's distinguish the single-step income statement from the multi-step income statement. The multi-step income statement reports a series of intermediate subtotals. It reports gross profit. That's sales minus cost of goods sold. It reports the subtotal for operating income, which is gross profit minus operating expenses. And it reports a subtotal for income before taxes, which is operating income minus non-operating income and expense. The multiple step income statement is the most common in practice by far. Why is that so? Let's look at the advantages of the multi-step income statement. The multiple step income statement format classifies operating and non-operating items and presents them in separate sections. That's helpful to investors. That's convenient, and to users of the financial statements. It provides information that is especially useful in analyzing trends at the business. Gross profit for manufacturers and retailers highlights the key relationship between the sales revenues, what customers are paying for our goods and services, and the direct cost of providing those goods and services. Operating income provides a measure of profitability for the core operations of the business. This is a key performance measure for predicting the future profit-generating ability of the company overall. Income before income taxes can be useful for comparing companies that are operating in different tax jurisdictions. Where one company might be quite successful, it just looks less so because it pays more taxes because it's in a heavy tax jurisdiction. All right. So now we will start to do cases to see how these financial statements are prepared and what they look like. In the next video, before we start preparing it, I'll walk you through the target income statement, and you can see the end product before we start to generate and develop income statements, both in the single step and the multiple step income statement. We will then look at a case on discontinued operations, earnings per share, and the statement of cash flows. Thank you very much for your attention, and have a wonderful day.